So, hello everyone. Good morning. My name is Om Rajpurohit and I'm part of DT team. And so today this is like a monthly newsletter which we used to present on each month. So we are first of all we are going to discuss some case laws and thereafter some important notification and all. So this is so first of all this is Delhi High Court case in case of Google India. So Google India was, Google India SSC was engaged in the business of providing cloud services, and so it was basically liable for equalization levy. There are two types of equalization levy. First was introduced in 2016, which was pertaining to advertisement, and the second was introduced in 2020, which is mainly related to e-commerce businesses like online e-commerce operator and also cloud services. So in this case, the SSC was making like receiving certain payments from Google Cloud India Private Limited, and the Google Global Cloud India was liable to deduct equalization levy. So thereafter, Global Cloud has like filed an application for low withholding certificate, and the department has directed them to pay 10% to withhold 10% TDS. So the contention of the SSC was since 2% has already been deducted in the form of equalization levy. So therefore the differential amount of 8% should be deducted in TDS in the form of TDS. So the contention of SSC was that as the payment of 2% was already made on account of equalization levy to CGI, therefore the remaining amount to the extent of only 8% is to be withheld. Further, the High Court, after relying in the case of APCO's electronic component, contended that maximum rate of as per DTAA is 10%, which is including surcharge. So there will be no additional burden of surcharge and cess. On the contrary, the revenue contended that the GCI is also liable to pay surcharge in addition to 8% of tax. So the High Court in writ petition took the decision in favor of SSC and held that since 2% has already been withheld or paid to the government in the form of equalization levy, so the remaining 8% should be withheld, and there will be no additional burden of surcharge and cess since the rate applicable is DTAA and not Income Tax Act. So it is, it is a very, I would say, favorable judgment because the department or the High Court has given the benefit of tax which is already withheld, maybe in the form of equalization levy or TDS. So the department, like High Court, has netted the total TDS. Now coming to the next case law, this is pronounced by ITT Mumbai in case of Ambuja Cement, and the judgment was pronounced in January 2022. So basically, this is the case is mainly pertaining to ESOP expenditure, and the I have already discussed in earlier presentation. So ESOP expenditure is mainly allocated over the period of vesting period. So in this case, the SSC company has filed return, and the case was selected for scrutiny, and the order was passed. But the PCIT has revised the assessment order under section 263 on the ground that the learned AO has passed an order which is erroneous and prejudicial to the interest of revenue. The main contention on or the main issue selected by the PCIT was with respect to ESOP expenditure. And PCIT, take the contention that since the vesting period in this ESOP scheme is 4 years, but the SSC has completely, taken the benefit of whole expenditure in 1 year. Therefore, the SSC has wrongly claimed the expenditure in a single year. So in this case, the contention of SSC was that during the course of ESOP period, the ESOP should be provided on fair market value. whereas earlier the company was following intrinsic value method. So due to this, since the method has been changed and from intrinsic value to fair market value, so the difference or the adjustment was made in P&L account as an exceptional item. Accordingly, the vesting period also came down from 4 year to 1 year, and thereby the whole expenditure is claimed in 1 year, in the 1 year itself. On the contrary, the contention of PCIT that even the legendary landmark ruling of Bangalore ITT in case of Bicon Limited also held that the expenditure of ESOP should be allowed under Section 37 over the period of vesting. So the court has taken or heard both the contention of SSC as well as revenue, and went on to hold. And this matter was decided by special bench of Bangalore, and held that since in this case the vesting period was only 1 year and not 4 years, therefore the basic condition is the ESOP expenditure should be allowed during the period of vesting. And since in this case, in this particular case, the vesting period is 1 year, so there is no contravention of earlier judicial precedent, and accordingly, the whole expenditure should be allowed in the year of vesting, which is 1 year. So the matter was decided in favor of SSC, and the court has so now what we understand from this case law, that even if like in various startup, the west in new startup, there's a as such there is no fixed criteria for distribution of ESOP. The vesting period can vary from 1 year to 5 year. So even if the vesting period is 1 year or like 2 year 3 year, whatever it is, the expenditure should be allocated in the year of vesting. So this ruling will be favorable, and the revenue cannot disallow the expenditure just merely for taking the basis that the vesting period is only one year. So in that sense, this ruling is also very important. Coming to the next case law, so coming to the next case law, this was allowed by issued by Gujarat High Court in case of Rajkamal Hills and Reeds Private Limited. Many of you might aware that 2020-21 was the first year when any SSE who is opting for concessional tax rate of 115 BAB or BAA has to file return for the first time. So before filing the return of income, the SSC who are taking the claim of such concessional rates shall file Form 10 IC prior to filing of income tax return. So in this case, what happened? The SSC, or I would say CA, forget to file the Form 10 IC and file the return of income. So since the Form 10 IC was not filed, the ITR was processed by CPC without taking the concessional rate of 22%, and therefore there was an addition of, or there was a demand of 1 crore rupees, since the tax rate was the department had computed tax rate of 30%. So as such, there was a negligence or mistake on part of SSC, and as such there is no particular remedy through which the SSC can is able to file manual return or also. So they have preferred an writ petition before the High Court, and during the writ, the contention of SSC that as the company is duly eligible to claim, as it is in domestic company and duly eligible to claim deduction under section benefit of section 115 BAA, and the return was filed first year, it is just because of inadvertent error of chartered accountant. So just because of the mistake of chartered accountant, the SSC should not be penalized, and the utility or income tax website portal should allow to file Form 10 IC electronically or and reprocess the return of income. On the contrary, the learned counsel The letter council of department has said that filing of 10 IC is pre-mandate to get the exemption or to get the benefit of section 115 BAA, and it is as per legal provision. So the PCIT or Chief Commissioner of Income are duty bound to follow the procedure of section 1192 of the Act. So the court has held like heard both the contention and it has like partially taken the decided in favor of revenue and partially in favor of SSC, and held that though there is a mistake, but the SSC should not be penalized, and the condonation of late filing of Form 10 IC should be taken into consideration by the department. And it also said that during that process, the AO should should not issue any recovery notice of demand, and in the meantime the SSC can file an application for abeyance before the AO, and the AO should decide the matter on the merits. So I would say this was kind of mistake, but again the High Court has decided or provided the partial relief to the SSC that even if they have forget to file the 10 IC, they can file a condonation of delay, and if the merits are correct, then the tax officer may accept the Form 10 IC and delete the demand. Coming to the next case law, this was Mumbai ITT in case of Rekin Beverage Private Limited. So the issue is mainly pertaining to share premium. So what happened in this case? The company was a private limited company, and it was engaged in the business of manufacturing of non-alcoholic beverage with the brand name of Raw Pressure. The company was already in huge losses during various previous year or financial year 2016, 17 and 17, 18. But the company has issued share on premium through Mauritius route. And there were two directors. One is very famous. One was director of the company and the other was Jacqueline Fernandez, the actress. And the premium was heavy in the form of like 2400 and 2786 on the share of 100 rupees. So it was nothing but seems like a rerouting of money from Mauritius route and conversion of black money into white money. So the department also took the note of it, and held that it is, since the company is already in losses and there is no basis that how the such huge security premium can be given to such company who is already in losses. So it seems like that it is money routed through Mauritius, and it is completely a black money. So the tax officer has also invoked the section 68, which talks about credit of unclaimed or unexplained money. So department also the decision of High Court like ITT was also in favor of revenue, and it has held that it is nothing more than the conversion of black into white money, and as such there is no basis or justification for such high uh, security premium. So again the department has tried to hinder such practices, wherein various SSC are trying to first they put some money outside India through Hawala or other routes, and thereafter they again reroute that money through security premium. So, and since there's one famous name, so again, this ITT judgment is important. So coming to the next case law, this is again pronounced by Mumbai ITT in case of Nayak Seafoods Private Limited. So the main issue in this case laws was pertaining to CSR expenditure and simultaneously claiming deduction under section 80G. This so first the idea was processed and order was also successfully passed in favor of SSC, but the PCIT has observed that the order is assessment order is erroneous and prejudicial to the interest of revenue. So therefore, it requires revision under section 263. Accordingly, the PCIT has issued a so-called notice wherein the CSR expenditure of 2.8 lakh was questioned, and also the 50% deduction of ATG was examined. So the contention of the SSC was that since the matter has already been examined in detail and the tax officer has called for numerous details and it was duly satisfied by him, so therefore this order cannot be treated as prejudicial or erroneous, and it is nothing but just mere change of opinion by the PCIT. Accordingly, the observation made by the PCIT that the assessing officer has not examined all the facts is is not legitimate claim by the PCIT. Moreover, regarding the disallowance of deduction under section 37 and ATG, it is the contention was actually that it is not mentioned in anywhere of the act that if any expenditure is allowed, specifically CSR expenditure is disallowed under section 37, then the same expenditure, if it is duly eligible to claim for ATG, the same cannot the claim for ATG shall be disallowed. So accordingly, the contention of PCAT is void and not in accordance with the law. On the contrary, the contention of revenue that since both CSR expense and ATG donation are two different mode of ensuring funds for public welfare, and the treating the same expenditure under two different head would defeat the purpose of law. And the revenue also contended that as per the memorandum, the legislative intention was to ensure that companies with certain strong financials make the expenditure toward this purpose and allowing deduction. The government would subsidizing one third by way of revenue foregone. Therefore, if any fund is allocated for public welfare, then the deduction is not permissible. The ITT has heard both the submission and contention and held that the SSC cannot be denied the benefit of deduction under Chapter 6A, that is ATG, while computing the taxable income, merely because the expenditure is in the nature of CSR and it would lead to double disallowance, would definitely going to defeat the purpose of intention of law. If the expenditure incurred is duly allowable or eligible under section 80G, then the SSC can claim the deduction for the same. So this is one again, and there are so normally what happen if any expenditure is disallowed. CSR expenditure is specifically mentioned in section 37, and it is held that any expenditure made towards CSR expenditure, then the same will be disallowed. However, there are certain expenditure like PM Care Fund. So if we make CSR expenditure towards PM Care Fund, then the SSC can also take claim under section 80G simultaneously. So this ruling has upheld that statement. Now coming to the next case law, which is again pronounced by Mumbai ITT. So what happened in this case law? SSC has filed return of income and he has declared capital gain of like 67 CR with respect to sale of shares. Later on, the matter was subject to reassessment due to certain report or investigation information received by investigation team Kolkata, whereby the revenue has made the addition under section 68 on account of sale proceed from share and treating the sale as bogus. On appeal, CIT appeal observed that as such there was no evidence that hold that the said money or the said sale proceedings are, bogus sales or unaccounted money. And the CIT also requested for remand report from the tax officer. So many of you aware, many of you might not aware what is remand report. So first, when the matter is examined by assessing officer, and if the matter goes against your favor, then if they, if the SSC is aggrieved by the order of assessing officer, then he filed appeal before CIT appeal. So there might be chances that all the details might already be submitted before the tax officer, and there might also be chances that there are some information was not submitted before the assessing officer, and which received later, which may be due to time constraint or other factor. The SSC was not provided proper opportunity and all. So there might be situation that in those information may be submitted before the CIT appeal. So CIT appeal always ask for remand report. It is nothing but a report or a reason seeking from the assessing officer why such information was not produced, or whether the information submitted during the appeal proceeding was already submitted before the assessing proceeding. So this is called as remand report, wherein that CIT appeal asks the status of information from the assessing officer. So in this case, the remand report was asked by the CIT from AO, and in that remand report, there was no adverse finding. So, like I said, uh, in the remand report, the assessing officer had to provide his input, which can be positive or negative. The reason, with some reason or remarks. So in this particular case, there was no adverse finding provided by the assessing officer in the remand report. So accordingly, the CIT appeal has deleted the addition, which is against the revenue. So revenue has filed an appeal. So during the ITT proceeding, the contention of the SSC was that since the shares were sold on high price, it cannot be treated as conclusive proof or a ground for an allegation that the SSC has converted some unaccounted or black money through accommodation entries by allegation of the assessing officer. On the contrary, the revenue has held that since because the remand report has only, stated that all the evidence has been submitted and genuine, so therefore it cannot be held that the transaction carried out by the SSC is proper and genuine. So the interesting thing is, even the assessing officer himself is saying that all the transaction, all the document has already been submitted. Then how can be this? How can this transaction be treated as conversion of unaccounted money through accommodation entries? So ITT also mentioned in its order that when the learned AO given a favorable report in his remand proceeding, then the fairly revenue not to be preferred any further appeal before the tribunal, as there could be not be any grievance for them. For this reason, the ITT also relies on the Madras High Court ruling in case of B. Jayalakshmi, wherein the High Court remanded the matter back to ITT for consideration of fact that where the AO has accepted the contention of SSC in the remand report and observed that the principle and the ratio decidedly laid down thereon would be squarely applicable to the facts of the instance case before us. Accordingly, the ITAT in this case allowed the matter in favor of SSC and terminated the revenues appeal and given the SSC a favorable order. So this case law provided that if all the documents has been genuine and there is a proper chain, merely because the assessing officer has doubt, he cannot treat the like he cannot treat such transaction as unaccounted or conversion of black money to white money. This is not so like important case law. I'm moving to next case law. So this is a circular. So now first part is completed. Now we are moving to second part, which talks about important circulars and all. So this is one circular with respect to most favored nation. So what is most favored nation? So let me tell you the background. This is I'm mainly talking about tax part. The most favored nation is not just from tax part, from all kind of business part as well. You might also heard in recently like there is a confliction between Russia and Ukraine, and many countries are revoking the MFN status to Russia due to that war. So similarly, we also have most favored nation in taxation. So what happened? Let me give you an example. Let's suppose A and B are two countries. Let's suppose India and Netherlands are two countries wherein they have one clause and the rate of royalty and FTS, I would say, or dividend. Let's suppose the rate of dividend between India and Netherlands is 10%. But there is one specific clause which is called as MFN clause in the treaty, which says that if India or Netherlands entered into tax treaty with other countries like thereafter, like let's suppose the India Netherlands treaty was signed in 1990, and they have this clause which says that India or Netherlands, any of those two, since treaty is applicable on both the countries, so if any of the country which are the party of treaty entered into a tax treaty with other country, let's suppose India is executing treaty with Lufthansa or like Slovakia or Colombia, any country, any third country, then if the rate of dividend is less than the rate already existing in current treaty, so if let's suppose the rate of treaty between India and Netherlands is 10%, and if India entered in a treaty with Slovakia, Colombia, or any third country wherein the rate of dividend is 5%, then the countries to this treaty will eligible to invoke the most favored nation. Means they can also reduce the dividend rate from 10% to 5%. So this is the most favored nation clause. It is not applicable to dividend. It can be applicable to royalty or any other tax rate or residential status. So I'm just trying to give an example. So let me complete this para. If you have any query, then you can ask me again if you don't understand these terms. So there was one high court. Why there was a need of this circular? Because there was one high court judgment in case of one Netherlands entity, when since in last 2 years this was not so relevant previously because the dividend was exempt in the hands of receiver, but now since the dividend is taxable in the hands of receiver and the companies are also liable to withhold taxes, so accordingly dividend is taxable in India is like 20% or income from other source. But in some treaties, the rate is 10%. In India Netherlands treaty, the rate of dividend tax is 10%. And since tax treaty or DTAA provision or Indian tax provision, which are more beneficial to SSC, will be invoked. So in India Netherlands treaty, since the tax rate in treaty is 10%, whereas in India the tax rate is higher side, so the effective tax rate is 10%. But India also executed some DTAA with Slovakia, Colombia, wherein the tax rate on dividend is only 5%. So considering that the Netherlands has invoked the MFN clause and it has filed a rate that the TDS rate should be or like tax rate should be only 5%, and accordingly the reduced rates should be applicable. So the department has come with and the ruling was also passed in favor of SSC, wherein the High Court has pronounced an order that the effective rate of tax on dividend is 5% only. So there was a huge revenue loss on part of department. So the department has to come with a clarification wherein they have provided certain condition when the MFN clause can be invoked. So first was the CBTT issued the following clarification on the applicability of MFN clause. First is unilateral decree bulletin publication do not represent the shared understanding of treaty. What this means that if any one country passed unilateral order in their respective country, then Like in India, Netherlands, the Netherlands department has passed an order without discussing with Indian counterpart that the MFN clause can be invoked. So this will not affect the this will not be treated as basic condition or prerequisite condition to invoke the MFN clause. The second condition is the, the conditionality of the third state being a member of OECD on the date of conclusion of DTAA. So means there is a requirement that the third state is to be member of OECD at the time of conclusion of the treaty with India and at the time of applicability of MFN clause. So what we mean is that when India and Netherlands has executed the treaty, at that particular time, the Slovakia and Colombia and Lufthansa were not part of OECD country. So this circular says that if any country wants to invoke in MFN clause, then the third country should also be part of OECD at that particular time, not afterwards. So, let me read out the condition, which this is nothing but rephrasing of the circular. There are four conditions. The second treaty, which is with the third state, it entered into after the signature entry into the force of the treaty between India and first state. The second treaty is entered into India and state is member of OECD. India limits its taxing right on the second treaty in relation to the scope of taxation in respect of relevant treaty, and a separate notification has been issued. So this is one condition which I missed, that India should also issue a notification that the MFN clause or the third treaty reduced rate should be applicable. For this, the separate notification shall also be introduced by India also, not just because an unilateral or one-sided notification issued by other country. So these are the four main conditions. So I think this concludes our today's presentation.